The Investor's Quotient. The Psychology of Successful Investing by Jake Bernstein. Book summary in English. Hey everyone, and welcome back to Powerbooks. If you're here to unlock your full potential and achieve success, you know we believe the greatest power lies within you. And nowhere is that more true than in the world of investing. Today, we're diving deep into a truly transformative book that reveals the hidden key to consistent financial success. The Investor's Quotient, The Psychology of Successful Investing, by the insightful Jake Bernstein. Have you ever wondered why even brilliant market analyses don't always translate into profitable trades? Or why you might find yourself making the same mistakes, even when you know better? Bernstein's groundbreaking work exposes a powerful truth: that long-term success in the markets is less about what you know about the market and much more about what you know about yourself. We'll explore how mastering your inner game, understanding and controlling your fear, greed, biases, and discipline is the ultimate leverage. This book isn't just about financial strategies. It's about developing your personal investor's quotient to navigate uncertainty, avoid common psychological pitfalls, and consistently make smarter, more profitable decisions. So, if you're ready to master your mind to master the markets, hit that like button, subscribe to Powerbooks if you haven't already, and let's unlock our financial potential together. Introduction: The Investor's Quotient. Welcome to a groundbreaking exploration that delves beyond charts and financial statements into the very heart of investment success. The Investor's Quotient. The Psychology of Successful Investing, by the esteemed Jake Bernstein. In a world often dominated by complex algorithms, economic forecasts, and endless market data, many investors overlook the single most critical factor influencing their returns: themselves. Jake Bernstein's seminal work serves as a powerful reminder that while technical analysis and fundamental research are essential tools, mastering the psychology of investing is the true differentiator between consistent profit and recurring loss. This book posits that every investor, whether novice or seasoned, possesses an investor's quotient, a measure of their psychological fitness for the demanding arena of the markets. Bernstein masterfully guides readers through the intricate landscape of human emotions, biases, and behaviors that constantly challenge rational decision-making. He illuminates how factors like fear, greed, hope, overconfidence, and denial can subtly, yet powerfully, undermine even the most well-resealed strategies. The Investor's Quotient isn't merely a theoretical treatise. It's a practical manual designed to help you understand your own psychological makeup as an investor, identify and overcome common behavioral pitfalls and emotional traps, develop the mental discipline and fortitude required for sustained success, learn from the psychological patterns of both winning and losing traders, transform your approach from reacting emotionally to executing with clear-headed logic. Bernstein argues that consistent profitability in the markets is less about predicting the future and more about managing oneself. This book is an indispensable guide for anyone seeking to gain a profound understanding of their inner game, turn psychological weaknesses into strengths, and ultimately elevate their investment performance to new heights. It's about optimizing the human element in the complex equation of financial markets. Chapter 1. My Story. In Chapter 1, My Story, Jake Bernstein likely establishes his credibility and introduces the foundational premise of the book through the lens of his own journey in the financial markets. This opening chapter typically serves as a personal narrative where Bernstein shares his experiences, both successes and failures, as a trader and investor. He probably recounts pivotal moments that led him to understand the profound impact of psychology on trading performance. For example, he might describe early struggles where sound strategies failed due to emotional interference like fear or greed, or breakthroughs achieved once he recognized and managed his own psychological responses. Bernstein uses his personal history to illustrate that market analysis alone is insufficient for consistent profitability. His story likely underscores the idea that a significant part of the investor's quotient lies not in predicting market movements, but in mastering one's internal reactions and decision-making processes. This chapter humanizes the often technical world of investing, showing that even experienced professionals grapple with psychological challenges, and that understanding these inner dynamics is a crucial step toward achieving lasting success. Through his narrative, Bernstein sets the stage for the book's deep dive into the psychological principles that differentiate successful investors from those who consistently struggle. Key takeaways. 1. Credibility through experience. Jake Bernstein shares his personal journey in the markets, including both triumphs and setbacks, to establish his authority and practical understanding of investment challenges. 2. Psychology's foundational role. His story likely highlights specific instances where psychological factors, rather than just market knowledge, were decisive in his own trading outcomes. 3. Relatability. By recounting his struggles and learning process, Bernstein helps readers connect with his experience and realize that emotional and mental challenges are common to all investors. 4. Setting the book's premise. The chapter serves as an anecdotal introduction to the book's core argument. Mastering investment psychology is paramount for consistent success, laying the groundwork for the detailed psychological insights that follow. Chapter 2. Many markets, many similarities. In this chapter, Jake Bernstein likely broadens the scope from his personal journey to a more universal observation about financial markets. He argues that despite the vast differences in instruments, volatility, and participants across various trading arenas, be it stocks, bonds, commodities, currencies, or futures, there exists a profound underlying similarity. This similarity, Bernstein posits, stems primarily from the consistent and predictable nature of human psychology. He illustrates that the same emotional forces, such as fear, greed, hope, and denial, drive participants in all markets. For example, the speculative bubbles and subsequent crashes seen in the stock market are echoed in commodity markets, real estate, or even cryptocurrencies, demonstrating that the collective emotional responses of human beings tend to play out in similar patterns regardless of the specific asset being traded. Bernstein uses this chapter to lay the groundwork for why a psychological approach to investing is so universally applicable. He emphasizes that while the technical indicators or fundamental data may differ from one market to another, the individual investor's internal battle with discipline, patience, and emotional control remains strikingly consistent. This insight reinforces the book's central message. Mastering one's psychological game offers transferable skills that are invaluable across any investment vehicle, making the investor's quotient a critical factor in diverse financial environments. He likely presents various examples of market phenomena to demonstrate these recurring psychological footprints. Key takeaways. 1. Universal psychological drivers. This chapter asserts that despite the distinct characteristics of various financial markets, example, stocks versus commodities, the fundamental human emotions of fear, greed, hope, and denial operate similarly across all of them. 2. Recurring market patterns. The consistent psychological responses of market participants lead to repetitive patterns, such as bubbles and busts, which can be observed across different asset classes. 3. Transferable psychological skills. Bernstein emphasizes that the psychological challenges of investing, such as maintaining discipline and emotional control, are largely the same regardless of the market, making mastery of these skills universally beneficial. 4. Focus on the human element. The chapter reinforces that understanding and managing one's own psychology is a more constant and crucial factor for success than simply specializing in the technicalities of a single market. Chapter 3. Psychology in the Markets, Similarities and Differences. In this chapter, Jake Bernstein further refines his argument regarding the pervasive role of psychology in financial markets, building upon the previous chapter's discussion of similarities across various trading arenas. Here, he likely explores not only the universal psychological forces at play, but also the subtle ways in which these forces manifest differently, depending on the specific market environment. Bernstein reiterates the core psychological commonalities: the influence of fear, greed, hope, and denial that drive human behavior in all trading contexts. He emphasizes that regardless of whether one is trading stocks, futures, currencies, or commodities, the fundamental human responses to profit and loss remain consistent. However, the chapter probably also dissects the differences in how psychological biases and emotional pressures play out. For example, Bernstein might discuss how the high leverage inherent in futures or forex trading can amplify feelings of fear and greed to a far greater extent than in unleveraged stock investing. He could also highlight how the immediate feedback loops in day trading foster a different psychological rhythm compared to the longer-term perspective required for value investing. The varying market structures, information flows, and degrees of liquidity might also create unique psychological challenges or exacerbate certain biases. Despite these differences, the underlying message is clear. While the expression of psychological factors may vary, the importance of understanding and managing one's own mind remains paramount for success across the entire spectrum of financial markets. Key takeaways. 1. Universal psychological foundation. This chapter reinforces that core human emotions like fear, greed, and hope are constant drivers of behavior across all financial markets. 2. Contextual nuances. Bernstein explores how market-specific characteristics, such as leverage, time horizons, or liquidity, can alter the intensity or manifestation of these psychological forces and biases. 3. Impact of market structure. The chapter likely details how different market structures lead to variations in psychological challenges and the types of emotional pressures investors face. 4. Psychology's enduring relevance. Despite these differences, the central theme is that the mastery of personal psychology is not only relevant but crucial, regardless of the specific market or trading style, because the core human element remains constant. Chapter 4. Psychoanalytic Theory. Do childhood experiences affect behavior? In this chapter, Jake Bernstein takes a significant turn into more foundational psychological theory, exploring the tenets of psychoanalysis and its potential, often unconscious influence on an investor's behavior. He likely introduces key concepts from figures like Sigmund Freud or Carl Jung, discussing how early childhood experiences, family dynamics, and even unresolved emotional issues can shape an individual's personality, biases, and responses in adulthood. Bernstein then meticulously draws parallels between these deeply ingrained psychological patterns and typical trading behaviors. He might illustrate, for example, how an individual's past experiences with risk, loss, or reward, perhaps from their upbringing or early life events, could manifest as an irrational aversion to taking necessary risks in the market, or conversely, an impulsive tendency towards excessive speculation. The chapter could delve into how deep-seated needs for control, security, or even unconscious fears of success or failure might lead to self-sabotaging actions or a persistent inability to follow a disciplined trading plan. Bernstein's aim in this discussion is likely not to suggest that investors undergo psychoanalysis, but rather to highlight the profound, often hidden, drivers behind seemingly irrational trading decisions. By understanding that behaviors rooted in early life can unconsciously influence present-day financial choices, investors can gain greater self-awareness and begin to address the underlying causes of their persistent trading errors. Key takeaways. 1. Unconscious influence. This chapter introduces the core psychoanalytic idea that early childhood experiences and unresolved emotional patterns can significantly and unconsciously shape adult personality and behavior, including trading decisions. 2. Trading as a mirror. Bernstein likely shows how deep-seated psychological tendencies, for example, risk aversion, impulsivity, or a need for control, might directly manifest in an investor's approach to the market. 3. Beyond conscious logic. The discussion emphasizes that some irrational trading behaviors may stem from deeply rooted psychological drivers that are not immediately apparent to the conscious mind. 4. Value of self-awareness. By exploring these psychoanalytic concepts, The chapter underscores the importance of profound self-awareness in recognizing and potentially mitigating the unconscious influences that contribute to recurring trading mistakes. Chapter 5. Learning Theory. Is all learning stimulus response? In this chapter, Jake Bernstein shifts focus to the realm of learning theory, particularly addressing the question of whether all human behavior, including that of an investor, can be reduced to simple stimulus response mechanisms. He likely introduces the foundational concepts of behaviorism, such as classical conditioning, where an individual associates a neutral stimulus with a significant one, and operant conditioning, where behaviors are shaped by rewards and punishments. Bernstein then applies these principles directly to trading. For example, a profitable trade acts as a positive reinforcement, making the investor more likely to repeat the actions that led to it, even if those actions were purely accidental. Conversely, a significant loss acts as a punishment, which, while intended to deter, can sometimes lead to maladaptive responses like freezing or revenge trading. He illustrates how repeated market experiences can inadvertently program investors with habits, both good and bad, through these conditioning loops. However, the is all learning stimulus response? Part of the title indicates that Bernstein likely goes beyond a purely behaviorist perspective. He probably argues that while stimulus response learning is a powerful force, it doesn't fully explain the complexities of successful investing. He might introduce elements of cognitive learning theory, emphasizing the role of internal mental processes like expectation, belief systems, and conscious reasoning. He could also touch upon social learning, where traders learn by observing others. The chapter's key message is that effective trading requires more than just automatic reactions to market signals. It demands conscious thought, emotional regulation, and the ability to adapt and learn from understanding, rather than just reacting to consequences. This sets the stage for a more nuanced approach to developing a winning trading psychology, moving beyond simple conditioning to deliberate mental strategies. Key takeaways. 1. Behavioral conditioning in trading. This chapter introduces how basic learning principles, such as positive reinforcement, profits, and punishment, losses, shape an investor's habits and responses to market stimuli. 2. Habit formation. Bernstein likely demonstrates how repeated market experiences can inadvertently program both beneficial and detrimental trading behaviors through stimulus response cycles. 3. Beyond simple responses. The chapter challenges the notion that all investment learning is purely stimulus response, suggesting that higher-order cognitive processes, beliefs, and conscious decision-making also play a critical role. 4. Implications for growth. Understanding the limitations of purely conditioned responses encourages investors to move towards deliberate mental strategies and self-awareness to break bad habits and cultivate more effective, rational behaviors. Chapter 6. The Response Sector. In this chapter, Jake Bernstein zeroes in on the crucial element of an investor's reaction to market stimuli, dedicating a focused examination to what he terms the response sector. Building on the earlier discussions of psychological theories and learning, Bernstein likely dissects the various ways in which investors respond to market movements, news, profits, and losses. He illustrates that while the market provides a constant stream of information, stimuli, an investor's actions are far from purely rational or automatic. Instead, they are deeply influenced by a complex interplay of emotions, cognitive biases, and ingrained habits. Bernstein probably categorizes and details common, often detrimental, responses such as impulsive buying or selling driven by fear or greed, revenge trading after a loss, freezing in moments of uncertainty, or abandoning a well-researched plan due to emotional pressure. He highlights the often costly consequences of these unmanaged reactions. The chapter likely emphasizes that the response sector is precisely where an investor exerts their true control and where their psychological quotient is most directly tested. By understanding the typical spectrum of human responses, both effective and detrimental, investors can begin to identify their own patterns and work towards cultivating more disciplined, objective, and ultimately profitable reactions to the unpredictable dynamics of the market. This chapter sets the stage for later discussions on how to consciously manage and rectify these responses. Key takeaways. 1. Focus on investor reactions. This chapter hones in on the investor's active response to market stimuli, identifying it as a critical area where psychological factors determine outcomes. 2. Spectrum of responses. Bernstein likely outlines various common investor reactions, ranging from beneficial, example, disciplined execution, to detrimental, example, impulsive trading, freezing, or revenge trading. 3. Psychological intervention. The chapter underscores that the space between a market event and an investor's action is where emotional and cognitive biases often intervene, leading to irrational choices. 4. Area of control. Bernstein emphasizes that the response sector is the primary domain where investors have agency. By understanding their typical reactions, they can work towards conscious self-management and improved decision-making. Chapter 7. The consequences of behavior. In this chapter, Jake Bernstein shifts focus from the nature of an investor's responses to the direct outcomes these responses produce. Building on the previous discussion of the response sector, Bernstein meticulously details how every action or inaction driven by an investor's psychology inevitably leads to specific consequences, both financial and psychological. He likely draws a clear line between undisciplined, emotionally charged behaviors and their detrimental results. For example, he might illustrate how impulsive buying fueled by greed can lead to overpaying for an asset, or how panicking and selling during a temporary dip can lock in unnecessary losses. Similarly, he would discuss the destructive spiral of revenge trading, where attempts to recoup losses only lead to deeper financial and emotional distress. Beyond the immediate monetary gains or losses, Bernstein also emphasizes the significant psychological toll. He likely describes how consistent poor behavior can lead to frustration, self-blame, burnout, and a profound loss of confidence, which then feed back into further irrational decisions. Conversely, the chapter would highlight the positive consequences of disciplined, rational behavior, consistent profitability, increased confidence, reduced stress, and the reinforcement of beneficial trading habits. The core message of this chapter is that understanding these direct links between behavior and outcome is crucial. By acknowledging the precise consequences of their actions, investors can begin to break negative cycles, learn effectively from their experiences, and consciously work towards cultivating behaviors that lead to sustained success rather than repetitive failures. Key takeaways. 1. Direct link to outcomes. This chapter explicitly connects specific investor behaviors, particularly those driven by psychological factors, to their direct financial and psychological consequences. 2. Negative behavioral consequences. Bernstein likely details how undisciplined actions, such as impulsive trading or panic selling, directly lead to financial losses and negative emotional states like stress and regret. 3. Positive behavioral consequences. The chapter also highlights how disciplined and rational behaviors result in consistent profitability, increased confidence, and a virtuous cycle of positive reinforcement for good habits. 4. Beyond monetary impact. It stresses that the consequences extend beyond just money, deeply affecting an investor's mental well-being, ability to learn, and long-term participation in the markets. Understanding this feedback loop is vital for self-improvement. Chapter 8. The Discovery Process. How to Know Yourself. In this chapter, Jake Bernstein shifts from diagnosing psychological influences to providing actionable strategies for self-improvement, focusing on what he calls the discovery process. He emphasizes that profound self-knowledge is the indispensable foundation for any investor seeking consistent success. Bernstein likely argues that before one can effectively manage their psychological responses in the market, they must first understand who they are as an investor, their inherent biases, emotional triggers, strengths, and weaknesses. The chapter probably outlines practical methods for this crucial introspection. For example, he might advocate for the rigorous practice of trading journaling, detailing not just the entry and exit points of trades, but also the emotional state, thought processes, and underlying reasoning at each step. This systematic record-keeping allows investors to identify recurring patterns of irrational behavior or specific market conditions that trigger detrimental responses, such as panic during sharp declines or euphoria during rallies. Bernstein may also suggest conscious self-observation, encouraging readers to pay close attention to their physical sensations, thoughts, and feelings before, during, and after trades. The aim of this discovery process is to bring unconscious psychological dynamics to the forefront, transforming vague feelings of frustration or regret into concrete, identifiable behavioral patterns that can then be consciously addressed and modified. It serves as a vital bridge between theoretical understanding and practical application of psychological principles in investing. Key takeaways. 1. Foundation of self-knowledge. This chapter stresses that deep understanding of one's own investing psychology, including biases, strengths, and weaknesses, is absolutely essential for improving performance. 2. Practical introspection tools. Bernstein likely introduces specific methods for self-discovery, with a strong emphasis on trading journaling to systematically record and analyze trades alongside emotional states and thought processes. 3. Identifying triggers and patterns. The discovery process aims to help investors recognize their individual psychological triggers, example, specific market volatility, and recurring detrimental behavioral patterns. 4. From awareness to action. The ultimate goal of knowing oneself is not just passive insight, but to gain actionable understanding that can be used to consciously modify behavior and cultivate the discipline needed for successful investing. Chapter 9, How to Rectify Trading Errors. In this chapter, Jake Bernstein moves from the crucial phase of self-discovery directly into practical application, detailing concrete methods for how to rectify trading errors. Having guided the reader to identify their psychological patterns and behavioral pitfalls in the previous chapter, Bernstein now provides actionable strategies to correct these detrimental habits. He likely emphasizes that awareness alone is insufficient. Active, disciplined intervention is required to transform insight into improved performance. The chapter probably outlines several specific techniques. For example, he might advocate for the rigorous implementation of rule-based trading, urging investors to develop clear, objective entry, exit, and stop-loss criteria that remove emotional discretion from the decision-making process. Bernstein could also discuss the importance of systematic post-trade analysis, encouraging a dispassionate review of past trades, especially losing ones, to pinpoint the exact behavioral errors committed, rather than simply dwelling on the financial loss. This process often involves revisiting the trading journal. He might also introduce mental techniques such as pre-mortem analysis, where an investor deliberately considers all potential ways a trade could go wrong before execution, or mental rehearsal of ideal responses to adverse market conditions. The core message is that rectifying errors is an ongoing, proactive process of cultivating disciplined habits and consciously overriding irrational impulses, thereby transforming identified weaknesses into sources of strength and consistency in investing. Key takeaways. 1. Actionable correction. This chapter bridges the gap between identifying trading errors from Chapter 8 and actively implementing strategies to correct them. 2. Practical techniques. Bernstein likely introduces specific methods such as strict adherence to rule-based trading, systematic post-trade analysis for learning, and mental rehearsal of correct responses. 3. Process over outcome. The emphasis is on improving the process of decision-making and execution, understanding that consistent application of these corrective measures will lead to better long-term outcomes. 4. Conscious intervention. The chapter underscores that rectifying errors requires conscious effort and discipline to override inherent biases and emotional reactions, leading to more rational and effective trading behavior. Chapter 10. Further details on dealing with trading problems. In this chapter, Jake Bernstein expands significantly on the practical advice introduced in How to Rectify Trading Errors, providing further details on dealing with trading problems. This chapter likely delves into more nuanced and persistent psychological challenges that investors face, offering advanced strategies for overcoming them. Bernstein probably acknowledges that simply identifying an error, as discussed in Chapter 8, and applying a basic corrective action, Chapter 9, is often insufficient for deeply ingrained behaviors. He might explore the underlying psychological drivers that cause certain problems to recur, linking back to the theoretical foundations established in earlier chapters. The chapter likely provides more specific, in-depth techniques for managing difficult emotional states such as intense fear, crippling greed, or overwhelming frustration, which often lead to repeated mistakes. For example, Bernstein might detail cognitive reframing exercises to alter one's perception of risk, or specific relaxation techniques to manage acute stress during volatile market periods. He may also discuss strategies for overcoming self-sabotage, examining why some investors unconsciously undermine their own success and offering pathways to break these destructive cycles. The emphasis here is on persistence and the understanding that psychological mastery is not an overnight achievement but an ongoing process of self-correction and continuous refinement. This chapter serves as a practical, advanced troubleshooting guide for the complex and stubborn psychological hurdles unique to the world of investing. Key takeaways. 1. Advanced problem solving. This chapter offers more detailed and nuanced strategies for addressing persistent or complex psychological trading problems that go beyond initial corrective actions. 2. Managing difficult emotions. Bernstein likely provides specific techniques for controlling intense emotional states like fear, greed, and frustration that consistently derail rational decision-making. 3. Overcoming deep-seated habits. The chapter focuses on methods for dismantling ingrained negative trading patterns and combating tendencies towards self-sabotage. 4. Continuous psychological development. It reinforces the idea that psychological improvement in investing is an ongoing journey requiring patience, persistence, and proactive self-management beyond simple fixes. Chapter 11. Scheduling and Self-Discipline. In this chapter, Jake Bernstein pivots to the practical behavioral aspects of psychological mastery in trading, focusing on the critical roles of scheduling and self-discipline. Building on the previous discussions about identifying and rectifying trading problems, Bernstein argues that consistent success in the markets is not merely about having the right strategy or psychological awareness, but about the disciplined execution of that knowledge. He emphasizes that haphazard or impulsive trading often leads to erratic results, while a structured, disciplined approach fosters consistency. The chapter likely outlines the importance of developing a rigorous trading schedule. This could include dedicating specific times for pre-market analysis, active trading windows, scheduled breaks to prevent burnout, and post-market review sessions. Beyond just time management, Bernstein delves deeply into the cultivation of self-discipline, which he portrays as a learned skill rather than an innate trait. He probably discusses how to consistently adhere to a predefined trading plan and rules, even when emotions are high or the market presents tempting deviations. For example, he might provide techniques for resisting the urge to overtrade, chase volatile markets, FOMO, or abandon a stop-loss order due to fear or hope. The core message is that true trading discipline involves consciously overriding natural human tendencies towards impulsivity or emotional reaction, replacing them with a consistent, methodical approach, thereby allowing investors to implement their strategies effectively and manage their psychological game proactively. Key takeaways. 1. Structure for success. This chapter emphasizes that implementing a structured trading schedule and routine is fundamental for consistent performance, counteracting impulsive behavior. 2. Cultivating self-discipline. Bernstein focuses on self-discipline as a vital, learnable skill, crucial for consistently adhering to trading plans and rules even under pressure. 3. Resisting common pitfalls. The chapter likely offers practical advice on how to use discipline to resist typical psychological traps like overtrading, chasing markets, or abandoning protective measures. 4. Discipline as a proactive tool. It frames self-discipline as an active, conscious process that enables investors to manage their psychological responses effectively and translate their knowledge into consistent, profitable action. Chapter 12. The importance of trading with the trend. In this chapter, Jake Bernstein shifts focus to a specific, widely recognized market strategy: the importance of trading with the trend. While this might seem like a purely technical discussion, within the context of the investor's quotient, Bernstein approaches it primarily through a psychological lens. He explains that aligning one's trades with the prevailing direction of the market, the trend, offers significant psychological advantages that can simplify decision-making and reduce emotional stress. For example, by following established trends, investors may experience less frequent whipsaws and a smoother equity curve compared to attempting counter-trend or range-bound strategies, which can be psychologically taxing. However, Bernstein likely also delves into the unique psychological challenges inherent in trend following, highlighting the paradox that even a seemingly straightforward strategy requires immense self-discipline. He probably discusses common pitfalls such as the difficulty of maintaining patience during long consolidation periods, the psychological pain of watching open profits diminish during retracements, which can tempt traders to exit prematurely due to loss aversion, and the fear of missing out on reversals. The chapter emphasizes that while the concept of trend following is simple, its successful execution hinges on the investor's ability to overcome these deeply ingrained emotional responses, adhering strictly to their rules and exhibiting the discipline discussed in previous chapters. It underscores that even the best market strategy is only as effective as the investor's psychological capacity to execute it. Key takeaways. 1. Psychological advantages. This chapter highlights that trading with the market trend can reduce emotional stress and decision-making complexity due to clearer signals and potentially smoother equity curves. 2. Discipline is paramount. Bernstein emphasizes that despite its apparent simplicity, successful trend following demands immense self-discipline to overcome psychological challenges like impatience, giving back profits, and the urge to pick tops or bottoms. 3. Counteracting emotional pitfalls. The chapter likely addresses common emotional traps inherent in trend following, such as loss aversion, closing winners too early, or the difficulty of holding through pullbacks. 4. Strategy meets psychology. It illustrates how a robust trading strategy like trend following can only be effectively implemented when an investor has cultivated the necessary psychological fortitude and self-control. Chapter 13. The role of advisory services. In this chapter, Jake Bernstein examines the role of advisory services, scrutinizing their function not just from a practical standpoint, but, crucially, through the lens of investor psychology. He likely begins by exploring the inherent human tendencies that drive investors to seek external guidance. For example, investors might turn to advisors out of a need for reassurance, a desire to delegate the immense responsibility of decision-making, or a hope for a holy grail of guaranteed profits. Bernstein probably highlights how fear of loss, lack of confidence, or the fear of missing out can lead investors to blindly follow advice without truly understanding the underlying rationale. The chapter then delves into the potential psychological pitfalls of over-reliance on advisory services. Bernstein might warn against the dangers of surrendering independent critical thinking, which can lead to blaming the advisor for poor outcomes instead of learning from one's own choices. He could also discuss how a mismatch between an advisor's risk tolerance or trading style and the investor's own psychological makeup can lead to discomfort, anxiety, or the abandonment of advice at precisely the wrong moment. Ultimately, Bernstein likely argues that while advisory services can provide valuable research, objective data, or serve as a sounding board, the ultimate responsibility for psychological discipline and decision-making rests solely with the individual investor. The investor's quotient cannot be outsourced. It must be developed and maintained internally, with advisors ideally serving as tools for information and perspective, not as substitutes for personal accountability. Key takeaways. 1. Psychological motivations for seeking advice. This chapter explores the underlying human needs, such as reassurance, delegation of responsibility, or a search for certainty, that drive investors to use advisory services. 2. Pitfalls of over-reliance. Bernstein warns against the psychological dangers of blindly following advice, including the loss of independent thinking, a tendency to externalize blame for losses, and a false sense of security. 3. Advisor-investor mismatch. The chapter highlights how a misalignment between an advisor's strategy, chart risk profile, and an investor's own psychology can lead to ineffective implementation or emotional distress. 4. Personal accountability remains. Key. The core message is that while advisors can be useful resources, the ultimate psychological discipline, decision-making responsibility, and cultivation of one's investor's quotient must remain with the individual investor. Chapter 14, Is This You? In this pivotal chapter, Is This You? Jake Bernstein directly engages the reader in a process of profound self-assessment. Following the extensive theoretical groundwork on psychological influences, learning behaviors, and the consequences of trading actions, Bernstein now challenges the investor to personally identify with the common psychological pitfalls and behavioral patterns he has described. The chapter likely presents a series of diagnostic questions, scenarios, or archetypal investor profiles designed to prompt honest introspection. For example, he might ask if the reader consistently cuts winning trades too short while allowing losing positions to run excessively, a classic sign of loss aversion. Or he might probe whether emotional states, such as boredom or frustration, frequently lead to impulsive or undisciplined trading decisions. The purpose of this chapter is not to pass judgment, but to foster critical self-awareness as the indispensable first step towards meaningful change. Bernstein aims to help readers recognize their own specific manifestation of the psychological challenges discussed throughout the book. By clearly outlining these common investor shortcomings and inviting the reader to see themselves in these descriptions, Is This You? Serves as a powerful call to action. It transforms abstract psychological concepts into personal, identifiable behaviors, thereby providing a strong motivation to apply the corrective strategies and cultivate the discipline necessary for improved trading performance. This direct challenge makes the investor's journey deeply personal and actionable. Key takeaways. 1. Direct self-assessment. This chapter prompts readers to identify their own specific psychological biases and problematic trading behaviors through direct questions or scenarios. 2. Personalized recognition. Bernstein aims to help investors see themselves reflected in the common pitfalls discussed, such as cutting profits short, letting losses run, or trading based on emotion rather than strategy. 3. Foundation for change. The chapter emphasizes that honest self-recognition is the crucial precursor to rectifying errors and building effective psychological discipline. You cannot fix what you do not acknowledge. 4. Motivation for action. By clearly illustrating personal behavioral patterns, Is This You? Provides a compelling reason for readers to commit to applying the psychological strategies outlined in the rest of the book. Chapter 15. Can a positive mental attitude facilitate consistent success? In this chapter, Jake Bernstein tackles a perennially popular concept: the role of, can a positive mental attitude facilitate consistent success in the demanding world of investing? He likely explores this idea with nuance, distinguishing between naive optimism or wishful thinking and a truly constructive, realistic mental outlook crucial for traders. Bernstein probably argues that a positive mental attitude, PMA, is not about blindly hoping for profits, but about cultivating a resilient, disciplined, and objective mindset that can navigate the inevitable challenges of the markets. He likely outlines the significant benefits of such a mindset. For example, a positive mental attitude fosters resilience, enabling an investor to bounce back from losses without succumbing to despair or revenge trading. It can enhance focus and clarity, allowing for better adherence to a trading plan and objective analysis, free from emotional fog. Bernstein might discuss how PMA promotes an openness to learning from mistakes, viewing them as valuable lessons rather than personal failures. However, he also likely provides crucial caveats, emphasizing that a positive attitude must be grounded in realism and strict risk management, lest it devolve into dangerous overconfidence that leads to excessive risk-taking. The core message is that while PMA won't guarantee success in every trade, it is a vital psychological component that facilitates discipline, improves decision-making, reduces stress, and sustains an investor through the inevitable ups and downs, thereby significantly increasing the probability of consistent long-term success. Key takeaways. 1. PMA defined. Realistically, this chapter clarifies that a positive mental attitude in investing is about cultivating resilience and objective thinking, not naive optimism or hoping for guaranteed outcomes. 2. Facilitating success. Bernstein likely explains how a constructive mindset can lead to benefits such as improved resilience to losses, enhanced focus, better discipline, and a greater openness to learning from experience. 3. Avoiding overconfidence. The chapter probably warns against allowing PMA to morph into overconfidence, emphasizing the need for it to be balanced with realism, humility, and rigorous risk management. 4. A crucial component, not a guarantee. The core message is that while a positive mental attitude is essential for sustained psychological well-being and consistent application of strategy, it serves as a powerful facilitator of success rather than a standalone guarantee of profits. Chapter 16, The Broker-Client Relationship. In this chapter, Jake Bernstein delves into the intricate and often psychologically charged dynamic of the broker-client relationship. He analyzes this partnership not merely as a transactional arrangement, but as a significant influence on an investor's psychological state and, consequently, their trading performance. Bernstein likely explores the common psychological pitfalls that can arise, such as an investor becoming overly dependent on their broker for reassurance or to offload the responsibility of making difficult decisions. This can lead to a surrender of personal accountability, hindering the development of the investor's own quotient. The chapter probably highlights the emotional impact a broker can have, for example, by inadvertently amplifying a client's fear or greed through their own enthusiasm or caution regarding market movements. Bernstein may also address the psychological challenges posed by potential conflicts of interest, where a broker's incentives, like commissions, might subtly pressure a client into trades that aren't optimally aligned with their long-term psychological and financial well-being. He likely provides guidance on establishing a healthy, functional relationship characterized by clear communication, mutual respect, and defined roles. The core message is that while a broker can be a valuable partner for execution and information, the investor must maintain their psychological independence, critical thinking, and ultimate decision-making authority to truly master their investment journey and avoid becoming a passive recipient of external influence. Key takeaways. 1. Psychological impact. This chapter emphasizes how the broker-client relationship profoundly influences an investor's emotional state and decision-making capabilities. 2. Pitfalls of dependence. Bernstein likely warns against the psychological dangers of excessive reliance on brokers, which can lead to a lack of independent thought and diffused accountability for trading outcomes. 3. Managing emotional influence. The chapter explores how a broker's advice or demeanor can inadvertently amplify client emotions like fear or greed, and how to navigate potential conflicts of interest. 4. Cultivating a healthy partnership. The core takeaway is the importance of maintaining psychological autonomy and critical thinking within the relationship, ensuring the broker serves as a tool for support and information rather than a substitute for personal investment mastery. Chapter 17, Putting It All Together, Where You Fit, Summary. In this pivotal chapter, Putting It All Together, Where You Fit, Jake Bernstein synthesizes the vast array of psychological insights and practical advice delivered throughout the preceding sections of the book. This chapter serves as a comprehensive integration point, challenging the reader to understand how the various psychological theories, self-discovery methods, error rectification techniques, and discussions on discipline and external relationships converge to define their unique investor's quotient. Bernstein's likely aim is to help the reader piece together their individual psychological profile, identifying their specific biases, strengths, and vulnerabilities in the context of financial markets. The chapter probably emphasizes that there is no singular, perfect investor or one-size-fits-all trading strategy. Instead, successful investing involves understanding and tailoring one's approach to align with their individual psychological makeup. For example, if an investor consistently struggles with impulsivity, Bernstein might suggest they are better suited for highly systematic, rule-based strategies that limit discretionary decisions. If patience is a challenge, perhaps certain long-term investing styles need specific behavioral modifications. The core message is about self-acceptance and strategic adaptation, recognizing one's inherent psychological tendencies, and then consciously designing or selecting trading methods, risk management protocols, and routines that complement, rather than conflict with, that psychological reality. This integration process allows investors to build a personalized framework for consistent success, where their strategy and their mental game work in harmony. Key takeaways. 1. Synthesis and integration. This chapter brings together all previous psychological concepts, methods for self-discovery, and practical advice to form a holistic understanding of the investor's quotient. 2. Personalized psychological profile. Bernstein guides readers to identify their unique psychological strengths, weaknesses, and biases, helping them understand where they fit within the broader investment landscape. 3. Tailoring strategy to self. The chapter emphasizes that effective investing involves adapting trading strategies, risk management, and routines to align with one's individual psychological tendencies, rather than fighting against them. 4. Harmonious approach. The ultimate goal is to achieve a coherent and consistent approach where an investor's chosen methods are in sync with their psychological reality, leading to more disciplined and successful outcomes. Chapter 18, Social Psychology and the Markets. In this chapter, Jake Bernstein expands the psychological lens from the individual investor to the collective, exploring the profound influence of social psychology and the markets. He argues that while individual biases are crucial, the dynamics of group behavior, or herd mentality, exert an equally powerful, often irrational force on market movements. Bernstein likely details phenomena such as conformity and social proof, where investors tend to follow the actions of a larger group, even if those actions contradict their own independent analysis or common sense. For example, the chapter might illustrate how the fear of missing out, FOMO, is amplified when widespread buying or selling sweeps through the market, pushing prices far beyond intrinsic value during bubbles or precipitating sharp crashes. Bernstein probably discusses how groupthink can lead to dangerous consensus among investors, suppressing dissenting opinions and encouraging irrational exuberance or collective panic. He emphasizes that the market is, in many ways, a reflection of collective human psychology, where prevailing sentiments can temporarily, or sometimes for extended periods, override fundamental logic. The chapter's critical insight lies in helping the individual investor recognize and resist these potent social pressures. It likely provides guidance on how to maintain independent thought, adhere to a personal trading plan despite the prevailing crowd sentiment, and avoid being swept up in irrational market frenzies, underscoring that true investment mastery often means standing apart from the herd. Key takeaways. 1. Collective behavior's influence. This chapter highlights how social psychological phenomena like herd behavior, conformity, and social proof significantly impact market dynamics, often leading to irrational price movements. 2. FOMO and groupthink. Bernstein likely explains how these powerful social biases can cause investors to make decisions based on what others are doing, rather than independent analysis, contributing to bubbles and crashes. 3. Market as a psychological entity. The chapter portrays the market itself as a manifestation of collective human psychology, where prevailing sentiment can dominate individual, rational thought. 4. Resisting the herd. The core takeaway is the critical importance of an individual investor cultivating the psychological strength to recognize and resist social pressures, maintaining independent thought and disciplined action against the collective tide. Chapter 19, Some Psychological Trading Rules. In this chapter, Jake Bernstein culminates many of the psychological insights from the preceding sections into a set of actionable psychological trading rules. This serves as a practical blueprint for investors to translate theoretical understanding into concrete, disciplined behavior. Bernstein likely presents these rules as direct antidotes to the common emotional and cognitive biases that derail even well-researched trading strategies. For example, he might include rules like never trade to get even to counteract revenge trading, or always use protective stop losses and honor them without exception to combat loss aversion and irrational hope. The chapter probably provides guidance on managing impulsive actions. Trade only when your setup is confirmed, never out of boredom or a need for action. Overcoming the fear of missing out. Don't chase runaway markets. There will always be another opportunity. And fostering patience and discipline. Wait for your ideal entry. The market will reward patience. Bernstein emphasizes that these rules are not merely guidelines, but mandates for consistent success, designed to help investors override their default, often irrational, psychological responses. He likely stresses that the true power of these rules lies not just in knowing them, but in the rigorous and unyielding self-discipline required for their consistent application, forming a robust defense against the emotional pitfalls of the markets. Key takeaways. 1. Actionable psychological guidance. This chapter translates complex psychological theories into clear, practical, and enforceable rules designed to guide daily trading behavior. 2. Counteracting biases. Bernstein provides specific rules aimed at directly combating common investor biases and emotional pitfalls, such as revenge trading, loss aversion, overconfidence, and impulsive actions. 3. Discipline is paramount. The chapter heavily emphasizes that the effectiveness of these rules hinges entirely on an investor's unwavering discipline and commitment to following them, even under pressure. 4. Framework for rationality. These psychological trading rules collectively form a framework that helps investors maintain emotional detachment, objectivity, and consistency in their decision-making, ultimately improving performance. Chapter 20. The Perceptual Factor. In this chapter, Jake Bernstein delves deeply into the perceptual factor, exploring how an investor's subjective interpretation of market information significantly impacts their decision-making, often more so than the objective data itself. He emphasizes that the markets are not observed identically by all participants. Rather, each investor filters information through their unique psychological biases, beliefs, and emotional states. Bernstein likely details how cognitive biases fundamentally shape perception. For example, confirmation bias causes investors to selectively notice and interpret data that supports their existing positions, while ignoring contradictory evidence, leading to reinforced but flawed convictions. He might also discuss anchoring bias, where initial price points or news headlines disproportionately influence subsequent judgments, or the framing effect, where the presentation of information dictates how it's perceived. The chapter underscores that these perceptual distortions directly lead to irrational trading errors, such as holding on to losing trades due to a skewed interpretation of market signals, or entering trades based on readily available but statistically irrelevant anecdotes. Bernstein likely provides strategies for cultivating a more objective perception, urging investors to actively seek out disconfirming evidence, rely on objective, rule-based trading systems rather than subjective interpretation, and use robust trading journals to compare their initial perceptions with actual market outcomes. The core message is that successful investing requires a conscious effort to differentiate between one's internal biased perception of the market and its external objective reality. Key takeaways. 1. Subjectivity of market view. This chapter emphasizes that each investor's perception of market data is heavily influenced by personal psychological filters, leading to varied interpretations of the same information. 2. Impact of cognitive biases. Bernstein details how specific cognitive biases, such as confirmation bias, anchoring bias, and the framing effect, can distort perception and lead to irrational trading decisions. 3. Distorted reality. The chapter highlights that these perceptual distortions are a major cause of common trading errors, as investors act on a flawed understanding of the market. 4. Cultivating objective perception. Bernstein provides methods for investors to overcome these biases, including actively seeking disconfirming evidence, adhering to objective trading rules, and using journaling to reconcile perception with reality. Chapter 21. Subliminal Perception. Response without awareness. In this chapter, Jake Bernstein ventures into the deeper, often unseen layers of psychological influence, exploring subliminal perception, response without awareness. Building on the previous discussion of conscious perceptual biases, Bernstein delves into how stimuli that are below the threshold of conscious awareness can still profoundly affect an investor's behavior. He explains that individuals might register information that is too brief, too faint, or otherwise peripheral to conscious attention, leading to impulses or emotional shifts whose true origins remain unknown to the investor. Bernstein likely provides examples of how this applies to the trading environment. Subtle cues, from market screens, rapid flashes of price movements, peripheral news headlines, or even the general mood conveyed through trading forums or news media, can potentially bypass conscious processing and trigger unconscious emotional responses or urges to act. For instance, an investor might feel an inexplicable urge to sell after seeing a rapid sequence of red candles, even if they haven't consciously analyzed the broader trend or context. The primary danger Bernstein highlights is acting on these unidentifiable impulses, as it becomes impossible to rationally evaluate or correct behaviors when their root cause is unknown. The chapter probably suggests strategies to mitigate such unconscious influences, such as maintaining a clean, distraction-free trading environment, enhancing overall self-awareness through mindfulness, and rigorously adhering to predefined, objective trading rules to circumvent spontaneous, unconsciously driven actions. Key takeaways. 1. Unconscious influence. This chapter introduces the concept of subliminal perception, where stimuli outside conscious awareness can still impact an investor's emotions and actions. 2. Hidden triggers. Bernstein explains how subtle market cues or environmental factors can bypass conscious thought, leading to urges or behaviors whose origins the investor does not consciously understand. 3. Danger of unaware responses. The primary risk is making irrational decisions based on impulses from unknown sources, which hinders rational analysis and correction. 4. Mitigating unconscious effects. The chapter likely suggests strategies to minimize subliminal influence, such as reducing distractions and strictly adhering to objective trading rules to avoid automatically responding to unseen cues. Chapter 22. Minimize stress, maximize health and profits. In this chapter, Jake Bernstein addresses a critical, yet often overlooked, aspect of successful investing: the direct correlation between an investor's stress levels and their overall health and profitability. He likely begins by delineating the myriad sources of stress inherent in trading, such as the constant uncertainty, the rapid-fire decision-making environment, and the emotional roller coaster of wins and losses. Bernstein explains how chronic stress can significantly impair cognitive function, leading to reduced focus, impaired judgment, and heightened susceptibility to behavioral biases, all of which directly undermine trading performance. The chapter then shifts to providing practical strategies for stress minimization. Bernstein advocates for a holistic approach, emphasizing both proactive measures and active coping techniques. For example, He might highlight the importance of disciplined risk management and setting realistic expectations to reduce the fear of ruin. He probably also details stress reduction methods like regular physical exercise, mindfulness, or meditation practices to maintain mental clarity, and scheduling deliberate breaks from the market to prevent burnout. The core message is that an investor's physical and mental well-being is not separate from their trading results. Rather, it is intrinsically linked. By consciously minimizing stress and prioritizing health, investors are better equipped to maintain discipline, think clearly, execute their plans effectively, and ultimately achieve more consistent and sustained profits. Key takeaways. 1. Stress as a performance killer. This chapter emphasizes that the high-stress nature of trading directly impairs cognitive function, emotional regulation, and decision-making, negatively impacting profitability. 2. Sources and impact of stress. Bernstein likely identifies common stress triggers in trading and explains their detrimental effects on mental acuity and physical health. 3. Holistic stress management. The chapter provides a range of practical strategies for minimizing stress, including proper risk management, realistic expectations, physical activity, and mindfulness practices. 4. Health profit link. The core message is that optimizing physical and mental health through stress reduction directly translates into improved discipline, clearer thinking, and ultimately, greater consistency and profitability in investing. Chapter 23. Often Asked Questions. In this chapter, Jake Bernstein shifts to a direct and interactive format, addressing a compilation of often asked questions that likely pertain to the psychological challenges and principles of successful investing. This chapter serves as a pragmatic Q&A session, allowing Bernstein to clarify common misconceptions, reinforce key lessons, and offer concise solutions to frequently encountered psychological dilemmas faced by investors and traders. He probably tackles questions that echo recurring themes from earlier parts of the book. For example, he might answer queries like, how do I overcome the fear of pulling the trigger on a trade? Linking to risk aversion and discipline, or what should I do when I feel the urge to revenge trade after a loss? Reiterating methods from How to Rectify Trading Errors. Bernstein uses this format to provide direct, actionable advice, often reiterating the importance of self-awareness, strict adherence to a trading plan, and emotional detachment. He might also debunk popular myths about trading psychology or the nature of success, providing a grounded perspective. The questions addressed could range from very specific behavioral issues to broader concerns about maintaining a healthy mindset over the long term. This chapter provides a valuable opportunity for readers to consolidate their understanding, ensuring that common stumbling blocks are directly addressed with the psychological wisdom woven throughout the investor's quotient. Key takeaways. 1. Direct problem solving. This chapter offers concise, practical answers to common psychological questions and challenges that investors frequently encounter. 2. Reinforcement of principles. Bernstein uses the Q&A format to reinforce core psychological principles discussed earlier, such as self-awareness, discipline, and emotional control. 3. Actionable advice. The answers provide immediate, actionable strategies that readers can apply to overcome specific behavioral pitfalls and mental hurdles. 4. Clarifying misconceptions. The chapter likely serves to clarify common misunderstandings about trading psychology, offering clear guidance from an experienced perspective. Chapter 24. Sex and the Markets, Fact or Fantasy. In this intriguing chapter, Sex and the Markets, Fact or Fantasy, Jake Bernstein likely addresses popular notions or stereotypes regarding how gender might influence investment behavior and success. Rather than engaging in a literal discussion, he probably uses the title to explore the psychological and potentially biological factors that are sometimes associated with differences in risk-taking, impulsivity, and emotional management between men and women in the financial markets. Bernstein might delve into observations or studies suggesting, for example, that women, on average, tend to exhibit more risk-averse behavior and less overconfidence, which could sometimes lead to more consistent, albeit perhaps less aggressive, returns. Conversely, he might discuss how certain masculine traits, when unmanaged, could contribute to overtrading or excessive risk-taking. However, the fantasy part of the title strongly suggests that Bernstein ultimately aims to debunk overly simplistic or deterministic views based purely on gender. He likely argues that while broad tendencies might be observed, individual psychological makeup, self-awareness, and disciplined execution are far more critical determinants of success than one's sex. The chapter's deeper message is probably that regardless of gender, every investor faces the same fundamental psychological challenges: fear, greed, discipline, and emotional control, and mastering these is universal. The variations observed are often due to a complex interplay of biological predispositions, societal conditioning, and individual experience, but the pathway to improving one's investor's quotient remains personal and transcends gender stereotypes. Key takeaways. 1. Exploring gender-related tendencies. This chapter likely examines whether there are observable psychological differences in how men and women tend to approach investing, such as varying levels of risk-taking or impulsivity. 2. Biological versus societal influences. Bernstein may touch upon potential biological factors, example hormones, or societal conditioning that could contribute to these observed differences. 3. Debunking. Stereotypes. The fantasy aspect implies that the chapter ultimately aims to challenge simplistic or deterministic views, emphasizing that individual psychological mastery is far more important than gender. 4. Universal psychological challenge. The core message is that while some gender-related tendencies might exist, the fundamental psychological challenges of investing, managing fear, greed, discipline, are universal, and individual self-awareness and control are paramount for success regardless of sex. Chapter 25. Using Psychology to Maximize Investment Success. In this crucial chapter, Jake Bernstein brings together all the threads of his extensive exploration, providing a comprehensive guide on using psychology to maximize investment success. This chapter serves as the culmination of the entire book, moving beyond identifying psychological elements to actively and systematically applying them for peak performance. Bernstein likely synthesizes the various concepts covered, from self-awareness and understanding biases to discipline, managing external influences, and cultivating a positive mental attitude, into a cohesive framework for ongoing psychological mastery. He emphasizes that while knowledge of markets and solid trading strategies are essential, it is the deliberate application of psychological principles that truly elevates an investor's performance from inconsistent to consistently profitable. The chapter probably details how investors can proactively integrate psychological management into their daily routine, perhaps by recommending a personal psychological plan alongside their trading plan. For example, he might advise specific mental exercises before trading, emotional check-ins during market hours, and objective psychological reviews after each trading session. Bernstein illustrates how strong psychological execution not only helps avoid common pitfalls like impulsive trading or cutting profits short, but also actively enables investors to seize opportunities with clarity and confidence, maintain composure during volatility, and ultimately realize the full potential of their strategies. This chapter powerfully reinforces the idea that true investment success is achieved when an investor fully understands and intentionally harnesses their inner psychological game. Key takeaways. 1. Synthesizing psychological tools. This chapter integrates all the psychological concepts and practical advice from the book into a unified, actionable approach for maximizing investment success. 2. Proactive psychological management. Bernstein stresses that actively and continuously managing one's psychological state is fundamental, advocating for deliberate mental routines and psychological planning. 3. Psychology as an accelerator. The chapter highlights how robust psychological execution is not just about avoiding losses, but actively enables the disciplined execution of strategies, allowing investors to capitalize on opportunities and maximize profits. 4. Achieving consistent success. The ultimate message is that true sustained long-term consistency and capital growth in investing stem directly from the intentional application of psychological mastery. Chapter 26, Writings of the Masters. Study history to learn about the future. In this chapter, Jake Bernstein emphasizes the enduring relevance of historical insights by exploring Writings of the Masters. Study history to learn about the future. Within the context of investment psychology, he argues that while market technologies and instruments evolve, the fundamental human psychological responses that drive market movements remain remarkably constant across centuries. Bernstein likely draws upon the wisdom of legendary investors, traders, or economic thinkers from various eras, demonstrating how their observations on fear, greed, panic, and euphoria are just as pertinent today as they were in their time. He might cite examples of historical market phenomena, such as the tulip mania or the South Sea bubble, to illustrate how the same patterns of irrational exuberance, herd behavior, and subsequent panic, driven by timeless psychological forces, have repeatedly led to speculative bubbles and crashes. The chapter reinforces the idea that true market understanding extends beyond merely analyzing current data. It requires a deep appreciation for how human nature continually expresses itself through similar cycles of emotional extremes. By studying the psychological lessons embedded in financial history, Bernstein suggests that investors can gain invaluable foresight, better equipping them to recognize and navigate similar human-driven market dynamics in the future, thereby avoiding old mistakes and consistently applying the principles of their investor's quotient. Key takeaways. 1. Timelessness of psychology. This chapter asserts that fundamental human psychological behaviors, fear, greed, herd mentality, in financial markets are timeless and have remained consistent throughout history. 2. Lessons from historical examples. Bernstein likely uses historical market events, example past bubbles and crashes, and the insights of legendary figures to illustrate recurring psychological patterns. 3. Foresight. Through hindsight. The core message is that by understanding the psychological drivers of past market events, investors can better anticipate and navigate similar situations in the future, regardless of changes in technology or market structure. 4. Validation of book's premise. Historical examples serve to validate Bernstein's central argument that mastering one's investor's quotient is an enduring key to success, as the human element remains constant. Chapter 27. Creative Visualization and Guided Imagery. In this chapter, Jake Bernstein delves into powerful applied psychological techniques, creative visualization and guided imagery, presenting them as vital tools for enhancing an investor's mental game. He likely introduces these concepts as methods of using the imagination to mentally rehearse desired behaviors, cultivate beneficial emotional states, and program the mind for successful outcomes. Bernstein explains the underlying principle. By vividly imagining positive trading scenarios or disciplined responses, an investor can effectively prime their brain and strengthen the neural pathways associated with those desired actions, making them more likely to occur in real-time market conditions. The chapter probably provides concrete examples of how these techniques can be applied. For example, an investor might be guided to visualize themselves calmly adhering to a stop-loss order despite intense fear, or confidently letting profits run instead of impulsively cutting them short. Bernstein might detail exercises for building confidence, overcoming specific anxieties related to market volatility, or mentally practicing the execution of a well-defined trading plan. He emphasizes that while these are powerful tools for self-improvement and developing a robust investor's quotient, they are not a substitute for rigorous market analysis, sound strategy, or disciplined risk management. Instead, creative visualization and guided imagery serve as crucial complements, enabling investors to optimize their mental state, improve execution consistency, and reinforce the positive psychological habits essential for long-term success. Key takeaways. 1. Mental rehearsal for performance. This chapter introduces creative visualization and guided imagery as techniques to mentally practice desired trading behaviors, emotional states, and successful outcomes. 2. Application to trading challenges. Bernstein likely provides specific examples of how visualization can help investors build confidence, manage fear and impulsivity, adhere to rules, and improve the execution of their trading plans. 3. Strengthening mental pathways. The underlying idea is that consistent mental rehearsal can program the mind, making disciplined and effective responses more automatic in real market situations. 4. Complementary tool. The chapter stresses that these techniques are powerful supplements to, but not replacements for, sound strategy, risk management, and overall trading discipline, acting as vital enhancers of the investor's quotient. Chapter 28. Overcome Your Worst Fears. How Psychology Facilitates Success. In this crucial chapter, Jake Bernstein confronts head-on one of the most pervasive and destructive forces in investing: fear. Titled, Overcome Your Worst Fears. How Psychology Facilitates Success. Bernstein likely dissects the various manifestations of fear in the trading arena, including the fear of loss, the fear of missing out, FOMO, the fear of being wrong, and even paradoxically, the fear of success. He explains how these fears can paralyze decision-making, lead to impulsive actions, cause traders to cut winners short, or hold on to losing positions too long, ultimately undermining profitability. The chapter then shifts to empowering the reader with concrete psychological strategies to mitigate and overcome these powerful emotions. Bernstein probably emphasizes that while fear is a natural human response, it can be managed through disciplined application of psychological principles. For example, he might highlight that robust risk management, proper position sizing, and strict stop losses is the most fundamental way to reduce the fear of ruin. He could also advocate for cognitive reframing, teaching investors to view losses as learning experiences rather than personal failures, or promoting mindfulness to observe fearful emotions without letting them dictate action. The core message is that true success in investing is not about the absence of fear, but about developing the psychological tools and discipline to acknowledge fear, understand its roots, and consistently act in alignment with one's trading plan, despite its presence. This chapter provides a roadmap for transforming fear from a debilitating obstacle into a manageable challenge, thereby unlocking an investor's full potential. Key takeaways. 1. Identifying core fears. This chapter directly addresses and dissects common fears in trading, such as fear of loss, FOMO, and fear of being wrong, explaining how they sabotage performance. 2. Fear's destructive impact. Bernstein illustrates how these fears lead to irrational trading behaviors like paralysis, cutting profits short, or letting losses run. 3. Psychological countermeasures. The chapter provides actionable strategies to overcome fear, emphasizing the foundational role of risk management, cognitive reframing, acceptance of losses, and disciplined adherence to a plan. 4. Empowerment through management. The core takeaway is that mastering fear through psychological tools and discipline is vital for achieving consistent success, enabling clear decision-making and optimal execution in volatile market conditions. Chapter 29. Why Too Many Traders and Investors Lose. In this crucial chapter, Jake Bernstein directly addresses the pervasive question, why too many traders and investors lose, asserting that the vast majority of failures in financial markets are primarily attributable to psychological shortcomings rather than flawed market analysis or poor strategies. Bernstein likely synthesizes many of the behavioral pitfalls discussed throughout the book, explaining how emotional reactions and cognitive biases consistently undermine otherwise sound investment approaches. He probably details how fear, greed, hope, and ego drive impulsive and irrational decisions, leading investors to common detrimental behaviors such as holding onto losing positions for too long due to loss aversion and hope, or cutting winning trades prematurely due to fear of reversal. The chapter emphasizes that a fundamental lack of self-discipline is a leading cause of consistent losses, manifesting as deviations from a trading plan, overtrading out of boredom or a need for action, or engaging in revenge trading after a setback. Bernstein also highlights the impact of cognitive biases, where distorted perceptions, such as confirmation bias or overconfidence, prevent objective decision-making. Ultimately, he argues that while market knowledge is necessary, it is the undeveloped investor's quotient, the failure to understand and manage one's own psychological responses, that creates a destructive cycle of emotional errors, inconsistent performance, and eventual financial losses for the majority of market participants. Key takeaways. 1. Psychology is the primary cause of loss. This chapter asserts that most trading and investing failures stem from psychological weaknesses rather than technical or fundamental analysis errors. 2. Emotional trading and lack of discipline. Bernstein identifies acting on fear, greed, hope, and ego, along with the inability to adhere to a disciplined plan, as key drivers of consistent losses. 3. Impact of cognitive biases. The chapter explains how various cognitive biases lead to distorted perceptions and irrational decisions that contribute significantly to poor outcomes. 4. Undeveloped investor's quotient. The core message is that the inability to understand and manage one's psychological makeup, their investor's quotient, is the fundamental reason why many traders and investors fail to achieve consistent profitability. Chapter 30. Modeling the Behavior of Successful Traders. In this chapter, Jake Bernstein shifts focus from identifying the reasons for failure to outlining the characteristics and behaviors that define consistent success in financial markets, specifically exploring modeling the behavior of successful traders. He likely emphasizes that profitability is not merely a result of superior market analysis or good luck, but rather the consistent application of specific psychological disciplines and behavioral patterns. Bernstein probably identifies key psychological traits common among top-tier traders and investors. For example, he might highlight their unwavering self-awareness, allowing them to recognize and mitigate their personal biases, and their uncompromising discipline in adhering to their trading plans and risk management rules, even under pressure. The chapter likely details how successful traders master emotional control, separating their feelings of fear, greed, and hope from their actual trading decisions, and demonstrate patience by waiting for optimal setups rather than forcing trades. Bernstein probably stresses their objectivity in interpreting market information, free from wishful thinking, and their adaptability to changing market conditions without rigid attachment to prior beliefs. By presenting these psychological attributes, the chapter provides a blueprint for readers to emulate. It underscores that successful traders embody a highly developed investor's quotient, consistently focusing on the quality of their process and mental execution, knowing that sustained profits naturally follow from disciplined, psychologically sound behavior. Key takeaways. 1. Behavior over outcomes. This chapter emphasizes that consistent success stems from specific, disciplined behaviors and psychological traits, rather than just market knowledge or luck. 2. Key traits of successful traders. Bernstein likely identifies crucial psychological attributes like self-awareness, unwavering discipline, emotional control, patience, and objectivity as hallmarks of successful investors. 3. Process-oriented approach. Successful traders focus on mastering their mental and strategic processes, understanding that this focus ultimately leads to superior financial outcomes. 4. Blueprint for emulation. The chapter serves as a practical guide, encouraging readers to actively model and cultivate these psychological behaviors to elevate their own trading performance and embody a high investor's quotient. Chapter 31. Facing the Challenges of Today's and Tomorrow's Markets. In this chapter, Jake Bernstein takes a forward-looking perspective, addressing facing the challenges of today's and tomorrow's markets. He acknowledges that the financial landscape is in constant flux, driven by rapid technological advancements, global interconnectedness, and the emergence of new financial instruments. Bernstein likely discusses how these evolving conditions introduce or amplify specific psychological pressures on investors. For example, the sheer volume and speed of information in modern markets can lead to information overload, anxiety, and impulsive decision-making, while increased volatility might heighten fear and stress. He might also touch upon the psychological adjustments required to navigate new phenomena, like algorithmic trading, cryptocurrencies, or the pervasive influence of social media on market sentiment. Despite these dynamic challenges, Bernstein's core argument in this chapter is likely that the fundamental psychological principles and disciplines detailed throughout the book remain timeless and essential. He emphasizes that a well-developed investor's quotient, characterized by self-awareness, emotional control, unwavering discipline, and adaptability, is not just crucial for today's markets, but is the ultimate tool for navigating and thriving amidst tomorrow's uncertainties. The chapter likely advocates for continuous learning, regular self-assessment, and a disciplined approach to managing one's mental state, asserting that by staying psychologically robust, investors can effectively withstand market shifts and consistently leverage their inner strengths for long-term success. Key takeaways. 1. Dynamic market landscape. This chapter acknowledges that markets are constantly evolving due to technology, global events, and new instruments, which introduce unique psychological pressures. 2. New psychological pressures. Bernstein likely highlights challenges such as information overload, the rapid pace of trading, and increased volatility as factors that test an investor's psychological resilience. 3. Enduring relevance of IQ. The core message is that the fundamental psychological disciplines of the investor's quotient, self-awareness, emotional control, discipline, are timeless and remain crucial for adapting to future market conditions. 4. Continuous adaptation and mental fortitude. The chapter emphasizes the need for ongoing psychological development and proactive mental management to navigate and succeed in an ever-changing and unpredictable market environment. Chapter 32. Some closing thoughts. Facing the challenges of today and tomorrow. In this concluding chapter, Jake Bernstein delivers a powerful final message, serving as a comprehensive wrap-up of the entire book's central premise. He likely reiterates with conviction the profound and often underestimated role of psychology as the ultimate determinant of success in the financial markets. This chapter synthesizes the most critical lessons, re-emphasizing that while market knowledge and strategy are important, it is the investor's mastery of their investor's quotient, their psychological capital, that provides the true and lasting edge. Bernstein probably touches upon the continuous battle against universal human emotions like fear and greed, the absolute necessity of unwavering discipline, the power of self-awareness in recognizing and mitigating personal biases, and the crucial ability to learn constructively from both successes and failures. He reinforces the idea that investment success is a long-term journey, requiring sustained psychological effort and resilience, especially when facing the challenges of today and tomorrow in an ever-evolving market landscape. The chapter likely concludes with a strong call to action and a message of empowerment, inspiring readers to continuously apply the psychological tools provided, take personal responsibility for their mental game, and consistently cultivate their investor's quotient as the most reliable path to not only financial prosperity but also enhanced personal well-being in the demanding world of investing. Key takeaways. 1. Final synthesis of psychological importance. This chapter provides a powerful concluding statement, reiterating that psychological mastery, or the investor's quotient, is the ultimate differentiator for success in investing. 2. Reinforcing core principles. Bernstein likely summarizes the most vital lessons, emphasizing the ongoing need for emotional control, discipline, self-awareness, and continuous learning. 3. Empowerment and personal responsibility. The chapter underscores that the most significant factor in an investor's success lies within their own mind and their commitment to developing it. 4. Enduring relevance. It offers a forward-looking perspective, affirming that the psychological principles discussed are universally applicable and essential for navigating the challenges of both current and future markets. And that wraps up our powerful journey through The Investor's Quotient, The Psychology of Successful Investing by Jake Bernstein. What an incredible deep dive into the true foundation of lasting financial success. We've explored how mastering your inner world, understanding your biases, controlling your emotions like fear and greed, and cultivating unwavering discipline is truly the ultimate leverage in the markets. This book isn't just about theory. It's about giving you the tools to transform your trading and investing results by transforming yourself. Now, if you're serious about taking control of your financial destiny and putting these game-changing psychological insights into practice, I highly recommend getting your own copy of Jake Bernstein's The Investor's Quotient. It's an indispensable guide for anyone committed to sustained market success. You can find the link to purchase it in the description below. Here at Powerbooks, we firmly believe knowledge is not power. The application of knowledge is power. And this book provides the exact knowledge you need to apply to truly master the markets. If you found this episode empowering, please smash that like button, subscribe to Powerbooks for more life-changing insights, and hit that notification bell so you never miss an episode. Keep applying these powerful principles, stay disciplined, and continue to unlock your extraordinary potential, both in your portfolio and in your life. Thanks for tuning in, and we'll see you next time on Powerbooks.